Imagine a stock so good it's like buying Amazon at 77 cents or Nvidia at 16 cents. This is what the Motley Fool is promising in their latest email. In this video, I will reveal the stock being pitched so you don't have to buy their newsletter. Just keep in mind, no paid or proprietary info is given away here, and it's all guesswork based on the clues in Motley Fool's publicly available email. Let's quickly look at the Fool's recent performance before we do anything. They recommended Alphabet in September 2024, and this stock is up a bit. Amazon was also recommended in September 2024, and this one is up a bit as well. Meta was also recommended in September 2024, and this one has performed the best of the bunch. The Fool recommended Lincoln Energy in November 2024, and the stock is seeing a little surge lately. At the same time, they recommended EQT, a natural gas stock, and this one is up too and has paid a nice dividend. BWX Technologies was the last energy stock recommended in November, and this one has done pretty well too. They recommended 5 microcap stocks in February 2025, and the first was Serve Robotics, which is down overall. Canixa Pharmaceuticals was the second stock, and this one has done really well and has almost doubled already. Ituran Location and Control was the third stock, and it's down slightly so far. The fourth stock was Carrot Packaging, and this one is down too. Karu was the last company recommended, and it's about break even. Let's look at the email now and figure out what the Fool is saying. They start by saying, "Dear reader, if you missed Amazon at 77 cents, if you missed Nvidia at 16 cents, you're not alone. And if you've ever said, I wish I could go back and buy them before the boom, you might want to pay close attention to what I'm about to say. Because there's another boom happening right now, a second wave of the AI revolution. And this one's already sucking in billions from the biggest companies in the world. I'm talking about hyperscale data centers. They're not flashy. They don't trend on social media. But they are, in our view, the invisible gold mines powering AI's future. And here's why that matters. Amazon is investing $35 billion in new centers. Google? $1.2 billion. Meta, $1 billion. Microsoft plans to build 50 to 100 new centers a year. Even Tesla is building one. And they finish off by saying all of that money has to go somewhere. And someone has to supply the next-gen hardware that makes these hyperscale AI engines run. That someone, according to our analysts, may be one particular company. It's a supplier so critical, Forbes says it will remain one of AI's biggest long-term beneficiaries. And here's the part that gets us really excited. It's already returned plus 1,166% since we first recommended it. Yet it's only tapped into an estimated 10% of its total market. That means this isn't just a play on AI's first wave. It's an opportunity to catch the second, potentially even bigger, chapter. I'm going to reveal the stock in 15 seconds, but before I do that, I want to remind you to sign up for my free report on the top 10 stocks to buy and hold forever. This report comes with no gimmicks, no get-rich-quick nonsense, just solid long-term investments you can actually feel confident owning. Click the link in the description to get your copy right now. The stock being pitched here by the Fool is Arista Networks, ticker ANET. Here's everything you need to know about this stock, and after I'll tell you if I'd buy. Arista Networks is an industry leader in data-driven client-to-cloud networking solutions, with a strong reputation for high-performance switching across large data centers, AI infrastructure, campus environments, and advanced routing platforms. Founded in 2008 and listed on the New York Stock Exchange in 2014 under the ticker ANET, the company built its foundation around its flagship extensible operating system and its suite of software-defined networking platforms. Today, Arista holds a leading share of the data center switching market, serving a wide range of cloud and enterprise customers around the globe. With a global workforce supporting its operations, Arista continues to strengthen its position as a dominant force in modern networking. Arista Networks has established a track record of strong and consistent financial growth, setting itself apart with industry-leading profitability metrics and sustained revenue expansion. From 2021 to 2024, the company delivered a compound annual revenue growth rate of 33%, while maintaining a best-in-class gross margin of 64% and operating margins exceeding 40%, highlighting its exceptional operational efficiency. This momentum is further reflected in its quarterly earnings growth of 33.6% year over year, underscoring Arista's ability to execute effectively and meet robust market demand. Arista Networks boasts a rock-solid balance sheet, operating entirely debt-free while holding a robust cash position of $8.84 billion, giving the company both strategic flexibility and ample capacity for future investments. Its financial efficiency is evident in a return on equity of 33.64%, reflecting the company's ability to generate strong value from its capital base. However, this financial strength comes with a premium price tag. Compared to peers like Cisco and Juniper, Arista trades at significantly higher valuation multiples, with a trailing PE of 55.75 versus 18.2 and 24.1, and a forward PE of 43.29 compared to 15.8 and 19.3. Similarly, its price-to-sales ratio of 12.8 far exceeds competitors' 3.4 and 2.1, while its PEG ratio of 1.85 still indicates growth-adjusted valuation is more favorable than Cisco and Juniper. This premium reflects strong market confidence in Arista's growth trajectory and profitability. Arista Networks continues to lead the data center switching market, holding a 21.3% share that keeps it just ahead of formidable competitors. However, the competitive landscape is evolving rapidly. NVIDIA has emerged as a powerful challenger, capturing 21.1% of the market by leveraging its dominant GPU ecosystem and tight integration with AI infrastructure, posing one of the most significant threats to Arista's position. Meanwhile, Cisco, long a traditional rival, maintains an 18.7% share, though its influence in data center switching has steadily declined over time. While Arista remains at the forefront, the rise of NVIDIA underscores a shifting market dynamic that could reshape the balance of power in the years ahead. Arista Networks is well positioned to ride the powerful wave of AI and cloud expansion, capitalizing on transformative technology trends that are driving unprecedented demand for high-performance networking infrastructure. The surge in AI adoption is a primary growth engine, with AI networking infrastructure expected to grow at an approximately 35% compound annual growth rate. Arista's specialized solutions are tailored to meet the demanding performance and scale requirements of AI workloads, ensuring it remains a key player in this emerging space. At the same time, the continued explosive growth of cloud computing and hyperscale data centers sustains strong demand for Arista's high-speed, low-latency networking products. Adding to its advantage, the company plays a leading role in the Ultra Ethernet Consortium, giving it direct influence over the development of future AI networking standards and reinforcing its long-term technological relevance. The case for Arista Networks to continue outperforming rests on its technological edge, strategic positioning, and proven execution. At the core of its advantage is EOS, the company's extensible operating system, which delivers superior programmability, reliability, and integration that foster long-term customer loyalty and create high switching costs. This best-of-breed technology positions Arista to capture outsized benefits from the surge in AI infrastructure investment, as its solutions are uniquely designed to meet the networking demands of machine learning and artificial intelligence workloads. Backing this opportunity is a consistent track record of growth, market share expansion, and disciplined financial management, underscoring the strength of its leadership team. Reinforcing the bull case, Wall Street analysts broadly rate the stock as a buy, with price targets pointing to meaningful upside potential driven by strong fundamentals and long-term growth prospects. The bear case for Arista Networks underscores several risks and headwinds that could weigh on its future performance. Chief among them is the growing threat from NVIDIA, whose rapid ascent in networking, combined with its dominance in GPUs, allows it to offer integrated solutions that may erode Arista's market share and pricing power in AI-driven segments. Valuation also presents a concern, as Arista's elevated multiples suggest much of its future growth is already priced in, leaving the stock vulnerable to sharp corrections if expectations are not met. Another key risk lies in customer concentration, with a heavy dependence on major cloud players like Microsoft and Meta. Any shift in contracts or strategic diversification by these clients could materially impact revenue stability. Finally, as the data center networking market matures, sustaining Arista's current high growth trajectory may become more difficult, with intensifying competition and slowing demand, potentially pressuring both margins and overall growth. So what do I think about this stock? First off, I think this is a great company. They execute with precision, dominate their market, and have the kind of reputation competitors dream of. Arista Networks is one of those rare companies. They've built a track record of strong growth, healthy financials, and smart positioning in some of the fastest growing areas of tech. If you want a company that feels built to last, Arista checks every box. That's the good news. The bad news? The stock market already knows it. Arista isn't a flash in the pan. They've proven themselves over time. Strong revenue growth, consistent profitability, and a balance sheet that doesn't weigh them down with massive debt. They've also built sticky relationships with some of the most powerful players in tech, and those contracts don't vanish overnight. This is the kind of company long-term investors love to own. Durable, growing, and aligned with major trends like cloud computing and AI infrastructure. If you're thinking about quality, Arista belongs near the top of the list. But here's the flip side. The stock price already bakes in years of perfection. At all-time highs, Arista trades at premium multiples compared to peers. Investors aren't just paying for the company's past success. They're paying for flawless execution well into the future. And that's risky, because the market doesn't need Arista to collapse for the stock to fall. A single miss on earnings, a cautious guidance update, even just a slowdown in orders from a major client could rattle investors. When a stock is priced for perfection, anything less than perfect can knock it down 20 to 30% in a heartbeat. It's not about whether Arista is a great company because it is. It's about whether the current stock price gives you a margin of safety. And right now it doesn't. So what's the move? For me, it's simple. Wait for the dip. Patience is one of the most underrated edges an investor has. You don't need to chase a stock at all-time highs. The market always gives you second chances. When Arista stumbles, and every company does sooner or later, that's when you step in. That's when the risk-reward shifts in your favor. That's when you get to own a great company at a reasonable price, instead of paying top dollar and hoping perfection continues forever. Before you go, don't forget to grab my free report. The 10 stocks I believe you can buy today and hold forever. It's packed with solid long-term picks you won't hear hyped up anywhere else. Just click the link in the description, enter your email, and I'll send it straight to you.